Insurance Stock Market Report, today's top developments. Interest rates boost yields while testing insurer balance sheets. As global interest rates stand at multi-year highs, insurers are navigating a two-edged financial climate. On one side, rising rates significantly boost the yields on insurers' fixed-income investments, providing a welcome lift to their earnings and offering relief after years of low returns. Insurance companies, especially life and annuity carriers, benefit from higher reinvestment rates, which strengthen their future income streams and help them offer more competitive products. On the other side, this same environment challenges their balance sheets, since long-held bonds decline in market value as yields climb, eroding paper capital and requiring careful capital management. The sector overall is balancing these pros and cons, welcoming improved investment income while closely monitoring interest rate risk to ensure that short-term volatility doesn't undermine long-term financial health. Analysts note that insurers today are far better capitalized to weather these shifts than in past cycles. At the same time, insurers must carefully manage the downside of rising rates on their finances. Industry leaders have highlighted that when interest rates spike, insurers often record significant unrealized losses on existing bond portfolios, accounting adjustments that can reduce reported equity and prompt regulatory scrutiny. However, these losses are generally manageable provided insurers maintain robust capital cushions and long-term investment horizons, since bonds will repay full value if held to maturity. Additionally, higher yields can alter customer behavior. For example, life insurance policyholders might lapse older policies to seek better returns elsewhere, adding another complexity for life carriers. In response, many insurers have been shoring up liquidity, repositioning some investments into shorter durations, and utilizing hedging strategies to protect against further interest rate swings. These proactive measures are aimed at safeguarding solvency while still allowing companies to take full advantage of the beneficial side of the high-rate environment. For some insurance companies, this period of elevated interest rates is actually leading to improved profitability and more room for growth. Higher net investment income has provided a buffer against any weakness in underwriting results, and several insurers have reported stronger bottom lines in the latest quarter partly due to this tailwind. As a result, investors appear cautiously optimistic about the sector's ability to leverage the rate environment. Insurance stocks, traditionally considered value and income plays, have remained resilient in market trading. Nonetheless, companies continue stress testing their portfolios against various interest rate scenarios, conscious that an unexpected change, whether a further rate spike or an abrupt drop, could quickly shift the outlook. By maintaining disciplined asset-liability management, insurers are showing they can both harness and hedge against interest rate swings, helping to ensure stability for shareholders and policyholders alike. Looking ahead, many in the industry expect interest rates to gradually stabilize, allowing insurers to lock in the benefits of higher yields for years to come. Subtopic: Balance sheet management in a high-rate era. Insurers' balance sheet management has taken center stage in this high-rate environment, as companies adapt their financial strategies to maintain strength. With long-duration assets losing value on paper due to rising yields, insurers are emphasizing capital adequacy and liquidity more than ever to reassure stakeholders. Many firms are shifting portions of their portfolios towards shorter duration or variable rate investments, reducing exposure to further interest rate increases. Others have layered on hedges or reinsurance of interest-sensitive liabilities, aiming to offset potential losses if rates continue to fluctuate. Fortunately, the sector entered this period with solid capital buffers by historical standards, and regulators have provided guidance to avoid forcing sales of underwater bonds at an inopportune time. As new bonds purchased today will eventually replenish earnings, insurers see a pathway to recouping these temporary declines over the coming years. In short, balancing yield opportunities with prudent risk safeguards has become a defining priority for insurance CFOs and risk officers navigating today's financial climate. Stable giants: How major insurance carriers are performing. Large insurance carriers, the household name companies spanning life, health, and property coverage, have shown resilience amidst recent market swings. Many of these entrenched players are valued for their steady earnings and dividends, appealing to investors seeking defensive, long-term holdings. Over the past year, however, performance has varied across subsectors. Some health insurance giants experienced share price declines due to rising medical costs and policy uncertainty, while certain property and casualty insurers delivered solid returns after successfully hiking premiums. Despite these divergences, the collective insurance sector remains on solid footing, benefiting from its fundamental role in the economy and relatively conservative balance sheet management. Overall, well-capitalized carriers have continued to weather macroeconomic pressures, reinforcing the notion that insurance stocks tend to provide stability even when broader markets are volatile. Even in times of market turmoil, these institutions often serve as anchors, with their risk management practices honed over decades. We see an array of strategic moves as carriers adapt to industry challenges and opportunities. For instance, one major life insurer has doubled down on retirement products, capitalizing on an aging population's growing demand for annuities and guaranteed income solutions. Many property and casualty carriers, on the other hand, have been focusing on disciplined underwriting and targeted rate increases, particularly in auto and home insurance lines hit by inflation. These actions have begun to yield results. After a period of high claim losses, some carriers are now reporting improved combined ratios and underwriting profits. The contrast between segments underscores that while all carriers must remain agile, tailored strategies based on their core markets are driving performance differences. For example, Progressive has leveraged its telematics data to maintain growth in auto insurance, while global giant Chubb used international diversification and disciplined underwriting to post steady returns. From an investor's viewpoint, major insurance carriers often look appealing due to their blend of stable cash flows and dividend yields. Several of the top stocks in the insurance sector are currently seen as undervalued by market analysts, trading at price-to-earnings ratios below broader market averages. This has led to a narrative of potential catch-up rallies. For example, some large insurers that faced short-term profit headwinds, like elevated claims in health insurance or catastrophe losses, are considered poised for recovery as those pressures ease. Moreover, carriers have been active in share repurchases and dividend increases, signaling confidence in future earnings. The combination of modest valuation, capital return to shareholders, and improved operating conditions has positioned many leading insurance stocks as potential value opportunities in a volatile market. For long-term stakeholders, the sector's consistency and gradual growth, coupled with selective tactical bets on turnaround stories, make it a cornerstone of many portfolios. Subtopic: Turnaround in P&C, an auto insurer's road to recovery. In a case exemplifying the sector's resilience, one prominent personal lines insurer has staged a notable comeback after heavy losses. A couple of years ago, this auto insurance leader was hit by a surge in accident claims and inflation-driven repair costs that dented its profitability. Management responded with aggressive premium increases across auto and homeowners policies, tighter underwriting criteria, and cost-cutting measures. These moves, while initially risking customer attrition, have gradually restored the insurer's combined ratio to healthier levels and returned its core auto insurance business to profitability. Investors took note. Over the last year, the company's stock has rebounded from its lows and even outperformed some peers, reflecting renewed confidence in its turnaround strategy. The insurer has also maintained a robust return on equity and sustained its dividend, reinforcing the message that it can navigate industry cycles effectively. This successful recovery underscores how focus on pricing discipline and operational efficiency can reinvigorate an insurance carrier's fortunes. Health versus P&C insurance, diverging pressures and prospects. Health insurance companies and property and casualty, P&C, insurers operate in distinct environments and face unique sets of challenges. Healthcare insurers must manage the rising cost of medical care and frequent policy changes in government programs, such as Medicare and the Affordable Care Act marketplaces, which can significantly impact their bottom lines. Over the past year, many health insurers saw upticks in medical claim expenses as patients returned for procedures and care delayed during the pandemic, compressing profit margins. By contrast, P&C insurers are contending primarily with inflation in repair and replacement costs, plus the ever-present threat of natural disasters adding unpredictability to claims. These differing pressures mean that, at any given time, the health insurance subsector can diverge from P&C in both financial results and stock performance, as each responds to its own risk drivers. For investors, this implies that diversification within insurance, owning both health and P&C names, can provide balance, as one segment's headwinds might be offset by tailwinds in the other. In 2026, these contrasts continue to play out in real time. Health insurers are focusing on negotiating better rates with hospitals and drug companies, investing in preventive care programs, and expanding into managed care services to keep medical loss ratios in check. They also face political scrutiny, with debates around prescription pricing and Medicaid funding influencing future growth prospects in that space. P&C insurers, meanwhile, are recalibrating their underwriting appetite in areas like auto insurance, where accident severity and repair costs have climbed, and homeowners insurance in regions prone to wildfires or hurricanes. This dual narrative shows that while both health and P&C insurers are part of the broader financial sector, the factors that move their fortunes can be dramatically different. Thus, a regulatory decision in healthcare or a severe storm in P&C can reverberate in their respective markets without necessarily affecting the other side of the insurance world. In the stock market, investors keep a close eye on these divergent dynamics within the insurance sector when making allocation decisions. For example, health insurance stocks sometimes trade more like healthcare companies, with performance tied to policy changes and patient trends, whereas P&C stocks are influenced by the property market and weather cycles. Lately, health insurers have been grappling with volatile medical cost ratios, which contributed to share price swings, while many P&C insurers have rallied as premium hikes and fewer severe catastrophes improve their profitability. Over the long term, both subsectors have proven capable of delivering strong returns, but at different times. Health insurers often outperform when macroeconomic conditions are stable and population aging drives demand, whereas P&C can shine when pricing cycles harden after industry losses. Understanding these patterns is key for investors seeking to balance growth and risk across insurance sub-industries, especially given that extreme events or policy shifts can quickly alter the outlook for one group without much impact on the other. For now, the consensus expects health insurers to rebound as cost pressures level off, while P&C insurers maintain momentum if they continue cautiously managing risk and pricing. Subtopic: Medical cost inflation challenges health insurers. In the health insurance realm, one major storyline has been the resurgence of medical cost growth and its impact on insurers' financials. After a period of suppressed healthcare utilization during the height of the pandemic, patients have been returning for elective surgeries, routine checkups, and treatments in large numbers. This rebound in healthcare usage, combined with expensive new pharmaceutical treatments hitting the market, has pushed medical claim costs higher than many insurers initially projected. Health insurers responded by adjusting premiums for the next enrollment cycles and working to implement more cost-saving programs like telehealth and disease management. They are also increasingly engaging in value-based contracts that incentivize healthcare providers to manage patient outcomes within budget, a strategy aimed at controlling long-term costs. Regulatory measures such as price transparency rules and caps on certain out-of-pocket expenses add another dimension, challenging insurers to innovate without compromising care. As these companies adapt, their profitability and stock performance in the near term will largely hinge on how effectively they can keep medical cost inflation in check while continuing to grow membership. Climate and catastrophe. Insurers confront extreme weather. A surge in costly natural disasters continues to put the spotlight on the insurance industry's exposure to climate-related risks. From massive hurricanes and floods to intense wildfires, the frequency and severity of catastrophes have remained elevated. Global insured losses from disasters have regularly topped the $100 billion mark in recent years, and insurers are bracing for the likelihood of more volatile swings in claims costs. In the United States, for example, multiple severe storms and wildfire seasons have pressured property insurers and their reinsurers, leading to some of the largest catastrophe payouts on record over the last decade. This challenging environment is forcing the industry to rethink how it models risk and prices policies to ensure that insurers can continue to cover claims without jeopardizing their financial health. Climate scientists warn that extreme weather events could become even more common, signaling that insurers must remain vigilant in their risk management strategies. In response to persistent catastrophe risk, insurers are taking notable measures to adapt. Many have significantly raised premiums and tightened terms in high-risk regions to better reflect the true cost of coverage, an approach known as risk-based pricing. There's also more reliance on sophisticated catastrophe modeling, using updated climate data to predict potential losses under severe scenarios and to set aside adequate reserves. Some insurance companies have reduced their exposure by limiting new policies or even withdrawing from markets most prone to disasters, especially where regulators restrict their ability to charge actuarially sound rates. These strategies reflect an industry striving to stay ahead of the climate curve, balancing the need to provide coverage with the necessity of remaining solvent after worst-case events. At the same time, innovation is being encouraged, such as parametric insurance policies that pay out automatically based on event measures, to offer new ways of covering certain disaster risks. For investors, the increasing clarity around how insurers handle catastrophe exposure is crucial in evaluating these companies. Firms that can demonstrate prudent risk diversification and effective reinsurance programs tend to reassure the market and often trade at a premium compared to peers with more concentrated risk. There is also a growing push for greater transparency in how insurers incorporate climate scenarios into their financial planning, with regulators and ratings agencies asking tougher questions about worst-case resilience. In light of this scrutiny, many insurance companies now publish detailed climate risk reports and incorporate climate change stress tests into their capital planning. While extreme weather will always introduce uncertainty, the capacity of insurers to adapt pricing, leverage new risk transfer solutions, and communicate their strategy is key to maintaining confidence among investors and policyholders alike. This approach of proactive risk communication and adaptation is increasingly seen as a hallmark of industry leaders in an era of climate volatility. Subtopic: Regional strains, Florida, California, and the insurance squeeze. For instance, some U.S. states are experiencing acute insurance availability crises due to repeated catastrophes. In Florida, successive hurricane seasons and heavy litigation costs have driven numerous insurers into insolvency or exit, prompting state lawmakers to intervene with market stabilization efforts. The state's last resort insurer, a public entity, has seen its policy count swell as private companies retrench, raising concerns about concentrated risk. On the other coast, California's drought-driven wildfire outbreaks have likewise led major insurers to limit new homeowners' policies, citing unsustainable losses under current regulatory constraints. In response, California regulators have begun exploring reforms to balance consumer protection with insurers' need to charge risk-reflective rates. These regional flashpoints illustrate how climate risk is not just an abstract global issue, but a tangible, localized crisis for insurance markets. The resolution of these challenges, through a mix of policy changes, improved mitigation, and innovative risk-sharing mechanisms, will be critical for maintaining insurance availability in vulnerable areas. Reinsurance market, from hard times toward recovery. The global reinsurance sector has been navigating turbulent waters in recent years, but is now showing signs of a potential turning point. After a series of heavy catastrophe losses and pandemic-related claims earlier in the decade, reinsurers enacted significant price increases and stricter terms, creating one of the hardest markets in recent memory. By the January 2026 renewal season, however, early indicators suggest that fierce pricing momentum may be easing slightly as fresh capital flows into the industry, attracted by higher premiums and improved prospects for returns. Alternative capital sources such as pension funds and ILS, insurance-linked securities, have poured additional capacity into the market, expanding reinsurers' ability to backstop risk. While reinsurance rates remain elevated relative to historical averages, this modest shift towards softening conditions could provide some relief for primary insurers facing the cost of transferring risk. Still, the memory of recent loss years means reinsurers remain vigilant, and underwriting discipline is expected to stay tight despite the growing capital base. Major reinsurance firms are reporting improved financial results due to the past years of rate increases and relatively manageable loss activity outside peak events. Their profitability has rebounded, and stock valuations for reinsurers have strengthened accordingly as investors gained confidence in the sector's pricing power. Reinsurers are also innovating their contract structures, offering multi-year deals and tighter exclusions to limit their downside in extreme scenarios. There's an increased emphasis on controlling exposure accumulations in vulnerable zones, as global reinsurers seek to avoid outsized concentration in any one region or hazard. This careful risk selection, paired with more abundant capital, leaves the reinsurance industry better positioned to support insurance markets in the face of future disasters. Industry experts note that a single severe catastrophe season could still test these improvements, but overall resilience has been bolstered by the lessons learned and measures implemented during the hard market phase. As reinsurance conditions gradually stabilize, primary insurers stand to benefit through more predictable and potentially affordable protection for their own books. If reinsurance premiums plateau or even fall in some segments, insurers may be able to secure the coverage they need without prohibitive costs, aiding their capacity to underwrite new business in catastrophe-exposed lines. Moreover, improved reinsurer stability is positive for the entire financial system, as it reduces the risk of cascading failures following a major disaster. Regulators around the world remain attentive. They often coordinate with reinsurance stakeholders to ensure that global risk-bearing capital remains sufficient. In summary, after several challenging years, the reinsurance market's cautious recovery is a welcome development that supports the broader insurance ecosystem, though all parties remain watchful for the next big test. For investors, the reinsurance rebound hints at more consistent performance ahead, but the memory of past volatility ensures that premium valuations will depend on sustained discipline and benign loss experience. Subtopic: Innovation, cat bonds, and the rise of alternative reinsurance capital. Over the past few years, alternative capital has played an increasingly important role in the reinsurance market, supplementing traditional reinsurance capacity. One notable trend is the booming issuance of catastrophe bonds, financial instruments that enable investors to take on a share of catastrophe risk in exchange for high yields. Pension funds and other institutional investors have found these cat bonds appealing for their returns and diversification benefits, particularly in a time of high interest rates. Likewise, specialized sidecar vehicles allow third-party investors to partner with reinsurers on specific portfolios of risk, sharing both premiums and potential losses. This inflow of global investment capital has helped relieve some pressure from the hard reinsurance market, providing more options for primary insurers seeking coverage. However, after a few tough loss years, alternative investors have become somewhat more discerning, demanding higher rates and stricter terms, which keeps overall discipline in check. The interplay between traditional reinsurance companies and alternative capital is now a defining feature of the market, helping to distribute risk more broadly across the financial system. Insurtech and innovation, technology reshaping insurance. A wave of technological innovation continues to reshape the insurance industry's landscape, driven by both nimble insurtech startups and the digital initiatives of established insurers. In the past few years, numerous insurance technology companies have emerged or matured, offering everything from app-based policy sales to AI-driven risk analysis. Some early insurtech darlings that saw frenzied growth and lofty valuations have faced a reality check, with investor focus shifting from pure growth to sustainable profitability. This has led to industry consolidation and a greater emphasis on partnerships, as many startups now collaborate with traditional insurers rather than trying to disrupt them outright. The result is a blending of old and new. Incumbent insurers adopting digital tools to streamline operations and reach younger customers, while former disruptors bring their innovations to scale under the umbrella of larger, experienced carriers. For consumers, this integration means more convenient online services and personalized products, as the best ideas from both tech-savvy newcomers and legacy insurers come together. Key areas of technological focus in the insurance sector include data analytics, mobile engagement, and automated underwriting. Many insurers are leveraging large datasets to refine risk models, for instance using telematics devices in cars to price auto insurance more accurately based on individual driving behavior. Mobile apps and online platforms have become critical for engaging policyholders, enabling everything from on-demand policy purchases to instant filing of claims with uploaded photos. Meanwhile, startups specializing in usage-based insurance, peer-to-peer risk sharing, and direct-to-consumer distribution have spurred established companies to elevate their digital game. Companies that successfully integrate these technologies can achieve lower operating costs and better customer experiences, which can translate into a competitive edge and more robust growth in their insurance portfolios. Conversely, those slow to adapt risk losing younger customers and market share to more innovative competitors, making digital transformation a near-universal strategic priority. In capital markets, the InsurTech segment has experienced both hype and correction. A few years ago, the promise of tech-driven disruption led to several high-profile InsurTech IPOs and lofty valuations. But since then, share prices for many of these companies have pulled back as investors demanded evidence of profitability. The survivors of the InsurTech shakeout are generally those who have carved out a niche or demonstrated viable unit economics. Traditional insurers are increasingly investing in or acquiring these innovators once they prove their models, further blurring the line between startup and incumbent. As technology becomes an integral part of all insurance operations, the narrative has shifted. Instead of a stark contest between old versus new, there's a consensus that tomorrow's insurance winners will be those who best meld deep industry experience with cutting-edge technological capabilities. With this in mind, the stock market has started rewarding established insurers that announce digital transformations, while remaining selective about standalone InsurTech ventures. Subtopic: Embedded Insurance, Seamless Protection at Point of Purchase. In one significant trend, insurers and technology firms are increasingly teaming up to offer embedded insurance coverage seamlessly integrated into non-insurance transactions. This means consumers can purchase insurance at the moment of buying another product or service, such as adding travel insurance during a flight booking or getting device protection at the point of sale for a smartphone. The embedded approach is gaining traction because it provides convenience and immediacy, reaching customers who might otherwise forego coverage due to the hassle of a separate process. Several major carriers have invested in API platforms and partnerships to enable this, allowing their policies to be sold through e-commerce sites, car manufacturers, and other third-party ecosystems. For InsurTech companies, embedded insurance has become a promising distribution strategy, as it offers access to large customer bases through established brands. This development is reshaping traditional distribution channels and could reduce the role of intermediaries for simpler insurance products. As embedded insurance takes off, industry observers expect it to play a growing role in expanding insurance penetration and simplifying how people buy coverage. AI in insurance, automation and opportunity. Artificial intelligence has moved from a buzzword to a practical toolkit in the insurance sector, with many companies increasingly relying on AI to enhance efficiency and insights. Across underwriting, claims processing, customer service, and fraud detection, machine learning algorithms and large language models are helping insurers analyze data faster and more accurately. For instance, AI systems can quickly sift through years of claims data to detect patterns that might indicate fraud or to refine risk models for pricing. In customer-facing roles, chatbots and virtual assistants are handling basic policy inquiries and guiding customers through claims steps around the clock, improving service and freeing human agents to tackle more complex issues. This broadening use of AI reflects insurers' drive to streamline operations and reduce costs while delivering a better experience to policyholders. Moreover, AI tools are being used internally, enabling underwriters and claims adjusters to make more informed decisions by providing them with data-driven recommendations. However, with greater adoption of AI comes a need for careful oversight and risk management to avoid pitfalls. Insurers are keenly aware that AI models must have high-quality data and robust governance to prevent biased decisions or unintended errors in areas like pricing or claim adjudication. Regulatory bodies and industry groups have started crafting guidelines for ethical AI use in insurance, emphasizing transparency in algorithmic decisions and the ability for human review. Some insurers have established dedicated AI governance committees, ensuring any machine learning tools are thoroughly tested and compliant with consumer protection laws. The hope is that by proactively managing these risks, insurers can fully harness AI's benefits without undermining trust or fairness. For example, the National Association of Insurance Commissioners, NAIC, has highlighted AI governance as a key focus for 2026, reflecting a broader industry consensus on tempered, responsible implementation. Already, some insurers are reporting tangible gains from their AI initiatives. Underwriting decisions that once took days can be completed in minutes for simpler risks, and automated claim approvals for straightforward cases have sped up payout times, enhancing customer satisfaction. The use of predictive models is also helping companies identify emerging risks faster, such as noticing upticks in certain types of claims or fraud attempts, and respond proactively. On the investment side, a few forward-looking insurers are using AI-driven analytics to better manage their asset portfolios under various market scenarios. While full-scale transformation is still a work in progress for most organizations, the direction is clear. AI is set to become a cornerstone technology that can differentiate the insurance leaders of the future. Industry analysts predict that those companies who effectively integrate AI across their operations will see significant competitive advantages, whereas late adopters may struggle to keep pace in efficiency and customer service. Subtopic: Real-world gains. AI transforms claims and underwriting. For example, one large global insurer recently rolled out an AI-powered claims triage system, dramatically accelerating how quickly it settles routine claims. By using machine learning algorithms and image recognition technology, the system can analyze photographs of auto damage or property losses and generate near-instant repair estimates. Early results from pilot programs show that such AI triage allows simple claims to be paid out within days or even hours, significantly improving customer satisfaction. The human adjusters in these scenarios can then focus more attention on complex or disputed claims, where their expertise is still essential. Other insurers are experimenting with similar technologies, such as predictive algorithms that signal when claims might escalate or which policyholders might consider lapsing. On the underwriting side, AI tools can parse medical records or sensor data to quickly assess risk for life and health policies, suggesting pricing that a human underwriter can then review. These real-world applications highlight how AI, when properly supervised, is complementing human decision-makers in insurance, enabling faster service and potentially lower costs. Insurance brokers evolve amid digital disruption. Insurance brokerage firms, those intermediaries that help businesses and individuals find the right coverage, are facing a dynamic market and new forms of competition. Traditionally, large brokers have thrived on their deep client relationships, market expertise, and negotiating power with insurers. In recent months, brokers have benefited from a strong demand for risk management services as companies navigate complex exposures, which has helped drive stable revenue growth. However, the rise of digital insurance shopping platforms and AI-driven comparison tools is creating pressure on certain areas of the brokerage business, especially personal lines and small commercial lines where transactions can be automated. The challenge for brokers now is to demonstrate their added value in areas where human insight and advisory capabilities outweigh the convenience of online tools. To remain competitive, brokers are highlighting their consultative role and ability to tailor complex insurance solutions that off-the-shelf digital channels might not easily provide. A clear example of this tension surfaced recently when news of a new AI-powered insurance comparison app roiled the brokerage sector. In a single trading session, shares of several top brokerage firms tumbled after investors feared that an automated platform could draw retail customers away. One widely cited case was the launch of an AI assistant by online marketplace Insurify, which can instantly analyze a consumer's profile, vehicle details, credit history, driving record, and fetch competitive auto insurance quotes. The prospect of an AI-driven tool replicating some functions of a human agent caused markets to speculate about widespread disruption. One major broker's stock saw its biggest one-day drop since the financial crisis, and peers also slid sharply. Industry analysts were quick to point out that while such technology is notable, it mainly targets simpler insurance Consulting roles brokers play for corporate clients. Brokers themselves downplayed the threat, emphasizing that they too are leveraging similar technologies to enhance their services rather than be supplanted by them. Indeed, leading brokerage firms are actively adapting, investing in their own digital tools to complement human expertise. They are developing advanced analytics platforms that can rapidly assess a client's risk profile and coverage gaps, so their advisors can provide recommendations informed by rich data. Some brokers are also exploring partnerships or acquisitions with insurtech companies to bring innovation in-house. The goal is to use technology as a force multiplier, improving efficiency and insight, while preserving the personalized guidance that distinguishes brokers. As a result, the major brokerages envision a hybrid model where AI handles routine tasks and data crunching, and human experts focus on strategy and relationships. This evolution should enable brokers to remain indispensable even as simpler insurance buying becomes more automated. Subtopic: Consolidation. Brokers pursue scale through M&A. Inside the brokerage industry, consolidation is another significant trend shaping the landscape. Over the past year, several mid-sized brokerages and managing general agents, MGAs, have been acquired by larger rivals or private equity-backed firms aiming to build scale. With valuations for brokerages high, owners have found it an opportune time to sell and join forces with national or global platforms that can provide greater market access and technology investment. One notable deal saw a well-known regional broker acquired in a multi-billion-dollar transaction, highlighting how intense competition and investor interest are reshuffling the sector. These mergers can create more diversified service offerings and cost efficiencies, but they also raise questions about market concentration and the fate of smaller, independent agencies. Nonetheless, many industry observers foresee continued consolidation as brokers strive to broaden their reach, leverage synergies, and meet the growing demands of clients worldwide. The result is likely to be an insurance distribution ecosystem dominated by fewer, larger players with extensive capabilities. Regulatory wins. Policy shifts affect insurance players. Regulation remains a key factor influencing the insurance sector, as policymakers and regulators globally seek to balance consumer protection with industry stability. In recent times, insurers have had to adapt to new rules on several fronts. Major accounting changes, such as the implementation of IFRS 17 internationally and updated GAAP guidance on long-duration contracts in the U.S., have altered how companies report their earnings and reserves. Meanwhile, various jurisdictions are pushing for greater pricing oversight in personal lines insurance, exemplified by state regulators in disaster-prone regions scrutinizing rate filings to ensure affordability. Overall, the regulatory environment for insurers is dynamic, with evolving standards that aim to keep pace with emerging risks like climate change and the expansion of technology. Insurers often engage closely with regulators and policymakers, providing data and feedback to shape workable rules that maintain solvency without stifling innovation. One area drawing significant regulatory attention is climate risk disclosure and management. Agencies in Europe and increasingly in the U.S. are developing guidelines requiring insurers to stress test their balance sheets against extreme weather scenarios and to publish detailed climate-related financial risks. Additionally, there's been movement toward modernizing capital requirements. For example, European regulators have been fine-tuning the Solvency II framework to potentially free up capital for insurers, while U.S. state regulators examine adjustments to risk-based capital formulas in light of low interest rates and new asset classes. The industry is carefully watching signals of a more permissive stance at the federal level in the United States, which could come with changes in political leadership and a focus on deregulation. Changes at the margin, like eased restrictions on certain investments or streamlined product approval processes, could provide modest tailwinds for insurers if they materialize. For the most part, however, core consumer protections and solvency standards remain firmly in place, meaning insurers must continue making compliance a central part of their strategy. Insurance companies frequently adjust their business practices to stay ahead of regulatory developments and avoid last-minute scrambles. Many have embraced a proactive stance, investing in systems to ensure data and reporting readiness for emerging mandates, such as those related to cybersecurity and data privacy, which are increasingly relevant. The cost of compliance is non-trivial, but insurers view it as a necessary investment in their reputation and long-term access to markets. From an investor perspective, regulatory stability and clarity are important. When rules are clear and capital requirements well understood, markets can better price insurers' risk and reward those who manage compliance efficiently. Thus, while regulatory shifts can introduce short-term uncertainty or one-time charges, especially with accounting changes, they are largely seen as navigable within the mature insurance industry, which has a history of adapting to new rules over time. Looking ahead, insurers expect ongoing dialogue with regulators on issues like AI ethics, climate preparedness, and consumer data usage as the next frontier of oversight. Subtopic: Accounting Overhaul, IFRS 17 and New Standards. A major recent regulatory shift has been in the realm of insurance accounting, fundamentally changing how insurers recognize profits from their policies. Internationally, IFRS 17 took effect, requiring insurers to measure insurance liabilities in a more standardized way across countries. This was a dramatic departure from earlier local accounting methods, creating initial volatility but ultimately giving investors a clearer picture of insurers' true margins on long-term contracts. At the same time, U.S. GAAP implemented its own long-duration targeted improvements, LDTI, altering how American life insurers account for products like life insurance and annuities. Companies have spent significant resources on these transitions. In 2025 and 2026, many have been explaining to shareholders the impact of the new accounting on their financial statements. While these changes don't affect the actual cash flows or capital positions of insurers, they do change the timing of profit recognition, meaning some firms appear more or less profitable under the new rules compared to the old ones. Analysts and rating agencies are adjusting their models accordingly, and the consensus is that after an adjustment period, the new accounting will lead to greater transparency and comparability across the industry. Deals and capital flows. Insurance sector repositions for growth. Beyond day-to-day market trading, the insurance sector has been witnessing significant strategic activity in terms of mergers, acquisitions, and capital raising. The past year saw an uptick in big transactions as firms sought to build scale or refocus on core businesses, with both insurers and brokers engaging in headline-grabbing deals. Private equity and other investors have poured billions into insurance ventures, either through direct acquisitions of insurance companies, backing reinsurance sidecars, or purchasing blocks of policies from established players. This influx of capital reflects confidence in the sector's long-term prospects and a recognition that insurance can generate steady returns, especially with interest rates favorable. At the same time, companies that felt pressure from tough market conditions have found lifelines or exit opportunities through these deals, helping to stabilize the industry. For example, insurers with volatile legacy portfolios have been able to transfer those to specialized runoff firms, freeing up capital to pursue new growth areas. Several noteworthy transactions are reshaping the competitive landscape. In one instance, a global insurance giant has made a bid to acquire a specialty underwriter, a move aimed at expanding into high-growth niche markets like cyber insurance and broadening its geographic footprint. Meanwhile, within the distribution space, large brokers have continued to consolidate, absorbing regional agencies to build even more extensive service networks. These deals often promise cost synergies and cross-selling opportunities, though integration can be challenging. Still, there's a sense that scale is increasingly important. Larger firms may better handle technological investment requirements and regulatory costs, and they can weather volatility with more diversified operations. This has only reinforced a cycle of consolidation as companies calculate that joining forces may better position them for the future. Industry analysts anticipate that robust deal-making will persist as long as capital remains available and valuations are reasonable. The rising interest rate environment, ironically, can facilitate certain types of deals. Higher yields make it easier to finance acquisitions, and they entice private investors with improved returns from insurance assets. The IPO window also appears to be reopening. A number of insurance-adjacent companies and insurtechs are rumored to be considering public listings to fund their growth in the coming year. All of these capital market activities indicate a sector in transition but not in distress. Strong players are opportunistically expanding, weaker ones are finding partnerships, and new entrants are obtaining the funding they need. The net effect is an insurance industry actively reinventing itself through capital and strategic moves, underscoring that change is a constant even in this historically stable sector. For investors, the consolidation trend can create short-term opportunities and long-term questions, as merged companies strive to deliver on growth promises and synergy targets. Subtopic: High-profile bid, Zurich's pursuit of Beazley. In a high-profile example of the current M&A wave, European insurance powerhouse Zurich Insurance Group made headlines with an offer to acquire